Hello again. Good to see you. We're going to be talking in the next three separate videos, each of the segments of the cash flow statement. Again, operating will be now in this particular segment, investing will be in the next, and financing will be in the third. So let's take a look at analyzing operating activities specifically. So if we're looking at operations, first section, and it's always in the same order, and we do have the two methods, indirect and direct method. They report the same amount. So just be aware we're not changing the method just because it's going to give different numbers. We're changing it basically for the ease of preparation. And you'll see down here, 98% of companies use the indirect method. So that's why we're emphasizing it. We're not going to worry about the 2% that use the direct method. Indirect will be emphasized on quizzes, tests, and it is emphasized and nationally for GAAP and used for most company presented statements. So we start with net income. That's the initial line that you see. And then we have adjustments to convert that net income to net cash flow from operations. So let's take a look at our balance sheet and our income statement. Notice in our balance sheet, we have a beginning cash balance and ending cash balance. Well, that's going to be showing at the bottom line, and we have $25,000 here to account for. It doesn't say it's in millions, so I guess it's $25,000. Now, notice we had receivables go up from $34,000 to $39,000. So that's a $5,000 increase in receivables. Not that we're being paid that extra. Eventually, we will be, but that is a use or a negative adjustment to our operations. Inventory went down. We have a $6,000 decrease in inventory. So these are actual direct adjustments that we're going to take care of things. Now we look here, I've got some long-term investments in property, plant, and equipment. That's not operations, nor the depreciation, nor the patents. I do have payables, income tax payable, accounts payable. So those are short-term, and those are current liabilities. We have to account for the $9,000 decrease in payables. How do we get a $9,000 decrease in payables? We wrote the check. We paid out $9,000. And then we have a bunch of other expenses on the income statement. If you see here, we have our sales and cost of goods sold, wage and insurance expense. We end up writing checks, but depreciation was the non-cash items. Gain on sale of land is one of those non-cash items. So we'll take a look at how to handle some of this a little deeper dive. So 4 steps to compute. Begin with net income. Adjust the non-cash stuff, expenses, gains, losses, non-cash expenses such as depreciation, amortization, gains and losses, so we sell assets or sell divisions. Then we adjust for changes in operating assets and current liabilities. So current assets and current liabilities, most of them will be calculated, change in receivables, change in payables, change in unearned revenue, change in prepaid expenses. Those are all going to be from the current asset and the current liability sides to be calculated. We're going to sum the items in 1, 2, and 3. And then we're going to take a look at how we actually do that. So here are adjustments. Net income is a number. Then we add depreciation and amortization back. We add or subtract, we add losses and subtract the gains, because the gain increased our income statement. But that was a non-cash item, so we have to reduce our income statement by removing that gain, or we add the losses. We actually deducted the loss like an expense. It reduces our net income, but we have to add back those losses. That's why the direction feels kind of funky when you say, wait a minute, I had a gain and isn't a gain a plus? Well, in the cash flow world, gain's a negative. We adjust for changes in non-cash current assets. And then we have, the cash is already going to be recorded in the cash flow statement, but the non-cash, like receivables, like inventory, like prepaid expenses, those are all current assets. And we have increases in those assets. We're financing somebody else. It's a use of funds. If we decrease those assets, it's like a sale, it's a source of funds. And there's the rules to live by. And you can pause this video and take a look and says, oh, I increase receivable, I deduct the increase. I decrease the receivable, I add the decrease to my netting to add it back. So inventories, payables, accruals, them's the rules that go along with this stuff. So here's an example. Step 1, begin with net income. Revenue expenses with no cash flow effect. So and or make adjustments accordingly. Gains and losses with no cash flow effect. Again, make adjustments. Changes in accounts receivable. Again, if our receivables went up, it's a negative effect. If our receivables go down, it's a positive effect on cash flow. Change in inventory, change in prepaid expenses. They are current assets. Changes in accounts payable. And you can get a summary of the operating section. Cash provided by operating activities. Start with net income. Make some adjustments. Gain on sale of land, we reduce it. Depreciation, we add it back. Receivable increase, negative. Inventory decrease, positive. Prepaid insurance decrease, negative. Increase, negative. Income tax payable, accounts payable decrease, negative. And income tax payable increase. Payable increases, we're borrowing somebody, using somebody else's money to do that. That concludes our operating section. Let's go on upward. Next section, and the OIF format. Next section is investing. Let's go take a look.